Good morning, everyone. Thank you for joining us. I want to welcome, first of all, I'm Lucinda Lambros. So those of you, most of you know who I am, a registered representative here in Southern California. And I've been with William Ryan Company for 7 years now. And have with us today a couple of people that have been in the industry, full of years of knowledge and information from Pacific Life. Kimberly Schultz is who I work with, and I'm going to read a few lines from her bio and from Ryan's bio to give you a quick introduction. Kimberly is the Senior Regional Vice President for Pacific Life, and she is based here in Southern California working with financial professionals. And she does this through a proactive consultative approach. Kim has been with Pacific Life for 25 years, bringing over $2 billion in assets to the firm. She has over 38 years of industry experience focusing on clients' unique needs. So welcome, Kim. Thank you. I have enjoyed getting to know you over the years and enjoy working with you. You're always a great source of information for me, and I truly appreciate our relationship. So thank you.
Thank you, Lucinda.
Our speaker today is Ryan Smith. He is a client portfolio manager with Pacific Funds. Ryan works closely with the portfolio management and analyst teams for the fixed income, equity, and multi-asset strategies offered through Pacific Funds. He is responsible for representing the investment philosophy, process, and portfolio positioning from each investment team. Prior to Pacific Funds, Ryan acted as a client portfolio manager and sat on the investment committee for Pacific Life Fund Advisors, a multi-asset subsidiary of Pacific Life overseeing $37 billion invested across domestic and international equity, fixed income, and alternative asset classes. He joined Pacific Life in 2015 and brings 12 years of industry experience with him. So welcome, Ryan. I'm going to turn this right over to you and let you get started. We're here to get a current market update and see where that conversation takes us. Thank you so much.
Thanks, Lucinda. Absolutely. I appreciate the warm introduction. And, you know, we chose the title today, Forward-Looking Markets and Backward-Looking Economies. And I think that really encapsulates what's happening in markets today because, you know, equity markets have hit all-time highs. They continue to run up since we had the initial crisis back in March. And at the same time, I think many people feel the reality of the underlying economy is just nowhere near justifying kind of what we've seen so far in the equity market. So there's this disconnect because markets are looking forward. And you know, they've had a lot of support from the Federal Reserve, from Congress, and the economy is very backward looking. So it's almost like you're trying to navigate and you're in a boat and you're looking backwards and you're just looking at your own wake, trying to figure out whether or not you're on track. And that's how the economy is typically you know, measured. And you look backwards at how consumer behavior changed. You look backwards at how consumer sentiment changed, at how businesses changed. Are they thinking that their business is going to improve over the next quarter? Or do they think things are headed for a worse direction? So all of these things are information that we're only able to gather after the fact, after it's occurred. And markets are very forward looking. So one of the things that happened after, you know, COVID hit, markets really hit a lot of volatility is, I think the key word to understand there is liquidity. And, you know, I don't want to keep this a technical term. All I mean is people's ability to sell what they have for cash, right? That's liquidity. And when you think about what happened with COVID, it was all about people trying to deal with the uncertainty of business shutdown, not bringing in any revenue, you know, what could potentially happen next. And so some of your longer term plans and longer invested assets, you might have been interested in getting a little more flexible, a little more like cash. And so you had basically everybody at the same time, and this was on a global scale, looking to improve their liquidity, improve the amount of cash that they had on hand. And that really disrupted markets to a degree that we really haven't seen pretty much at any other time in the way that they normally function. So that was the precedent that kind of set markets topsy-turvy with what's happened in COVID. And obviously, there's been a lot of economic impacts from that. We had an instantaneous recession where, usually we're some ways into it before we can establish that we've entered recession. But, the first quarter ended up with negative GDP growth by just a little bit. And the second quarter obviously was hit really hard. And so, the economic scenario changed very, very quickly as well. And so you saw the immediate movement by the Federal Reserve. You saw immediate movement. Well, I wouldn't say immediate, slightly more delayed movement from Congress, but we did have the CARES Act. We did have the PPP for all its faults. Excuse me, I'm not just going to use acronyms here. Paycheck Protection Program. I can't even remember what it stood for anymore, but it's a small business support program that allowed small businesses loans that were forgivable, right? That was something that was key, I think, that came out of the CARES Act. But the Fed was first and foremost to move. So when you try to think about how markets could be where they are today, and you rewind to the liquidity, basically crunch that occurred when everybody tried to get more cash at the same time, because they're all facing, and again, this is globally, this wasn't just in the US or in one part of the economy. It wasn't just a housing sector or a banking sector. It was everybody looking to get more cash so they could deal with paying the bills, keeping things open while they're not bringing in any revenue. So from that, you saw the Fed act first. And that was with programs to help shore up the biggest market in US Treasuries. So that was something that they'd done before in 2008. All the piping's in place there. And so they were able to immediately start supporting that market by purchasing treasuries. And they introduced a number of different programs, call it an alphabet soup of support programs to help different parts of the market that had basically either locked up, frozen up, broken down, any way you want to look at it, to help them function more normally again. So that was something that they did. And at the same time, they reversed what they had been doing over the last couple of years and dropped rates immediately down to zero. So those were some of the things that they did right off the bat. And one of the last things that they did, which I think marked so far the bottom of the market, was on March 23rd, they announced support for corporate credit, which is when you think about companies and how they finance their activities. One of the first things that they do when they're looking to finance their activities is go to the bond markets. Right? They don't have to raise equity. They don't have to get new investors. They don't have to, do all they have to do is find people who are willing to lend them money, and then they would slowly pay those investors back with interest rate, and then finally, they would pay back the money that they lent. So that corporate bond market is crucial to the functioning of the U.S. economy. The whole idea of having a lockdown and preserving jobs to go back to with the CARES Act and with all the Fed actions means that companies need to be around for those jobs to continue to be there when people finally go back to work. So, a big part of that was that corporate facility that was announced. And it was no surprise that marked the bottom of the market, because that was kind of the last component to marketplaces that weren't functioning normally that needed help. And, from that point, when you're looking at markets, you've already seen a huge drop. I think we had 30+ % drop from where the market peaked to where it ended up before it started back up again. So you had that enormous drop. And from there, you've already priced in a lot of bad stuff, right? And from that point, markets take a look at what's happened in terms of the economy. They start to look backwards, like we talked about, to see, all right, what's in the wake? What do we actually see? And is that measuring what our expectations were? And what ended up happening is markets, the only way you can put it is they got a little overly pessimistic. They thought things would be far worse than so far they've turned out to be from an underlying economy standpoint. So many didn't think you'd have any kind of significant recovery in economic growth until maybe the fourth quarter or even next year. And at this point, market forecasts are for as much as 32% growth in the third quarter. And so, if you look at a slightly less than 32% drop in the second quarter and a 32% growth, the math doesn't work out to get back to even, but that's a pretty, I don't know what qualifies as a V-shaped recovery, but that's a pretty strong economic performance. And so I don't think that was widely expected in terms of markets. And so when you look at all the support that was provided, just how deeply markets dropped, and then how expectations basically weren't necessarily met, I think that's kind of where you find yourself, where markets have this ability to price in from our expectations, things have improved. And that's why I think markets have moved up from where they were. And, one of the other things that goes along with that is interest rates. Now, I don't want to get technical, but just suffice to say, when interest rates are lower, the same dollar of earnings you're getting from a company is worth more, right? Because you can't go to the federal government, take out a bond that's risk-free and get any interest right now. It's practically, 10 years under 70 basis points last time I looked. That's a 10-year bond where you're getting 0.7% interest each year, right? That's about all you can get on a risk-free basis. So everything else looks to be a little bit more valuable. So I think that has some impact on why you could see equity markets at all-time highs. Now, what are our expectations from here? Well, we have been seeing some of the underlying kind of growth and recovery at the company level. So you see companies in sectors of the economy, demonstrating how that they're recovering and showing a path to getting back to more normal operation. So you can kind of see that in certain sectors of the marketplace. Some sectors of the marketplace, like technology, have really not shown much hitch at all, and have in fact maybe benefited a little bit from the focus on all the technology involved in working from home, right? So there's been a boost there in the fact that there's some pretty direct involvement of some of those companies like Zoom, right? Other companies benefit just by the fact that you're gonna get a little more, you're gonna pay a little more for growth when growth is hard to come by. So that's something that you've seen as well in equity markets as a result. But there's other sectors of the market, like airlines, down at least 70% from where they were a year ago. You have retail that was struggling before with a lot of issues, and now you've seen a number of defaults in that space where companies have filed for Chapter 11, and other parts of the market like energy, which have been hurt by a number of things. Obviously, people traveling less is a huge component to that, but you also have that other factor of a global price war that was initiated literally as COVID was hitting. So, there's some additional issues that kind of hit some of those parts of the market in that, in leisure travel, cruise ships, that's another part of the market where, there aren't as many signs, and there's still signs that there could be challenges ahead in those parts of the market. Although, they have improved as well. So even though, down 70%, some of that, airlines actually were doing a little better before the July increase in coronavirus cases. Some of those capacity figures were a lot better. And then they've seen it kind of tail off again. So I think, some of those were showing signs, some of them still are, but it'll remain to be seen kind of based on what happens, how they end up in terms of each of those different sectors. But, housing is another one where there's a huge demand for housing. And at this point, some of the challenges in the housing sector actually come down to supply chains and having enough material to build houses and build them in a quick enough fashion to get them to market. So that is another part of the market that may continue to show some promise. Now, from an overall standpoint, one of the things I haven't mentioned that bears just mentioning briefly is the election. When I look at that, lesson learned from 2016 is that, if you knew what was going to happen, most of the investment professionals that I dealt with, their if this then that, their implications for what would happen if something unexpected occurred were wrong. So even if you have success in identifying which candidate gets elected, I think the lesson there is, what you would expect to happen if that's the case may also be wrong, right? And I think that was a lesson learned from 2016. One of the things that it is important to recognize, though, is that we typically see higher volatility in years, especially in the months prior to election. So you tend to see more ups and downs and swings in the market. And so far, I don't see that this year has been any different. We've seen kind of an uptick in the level of up and down in the markets as we've kind of neared the election. And a lot of things go into that, of course. But I don't think it's as easy to identify and figure out what any given candidate or scenario means in terms of equity markets. So I think that's something that I would hesitate to make any predictions about. So those were some of the comments that I had. I don't know if there's any part of the market that you would like me to touch on that I left out, but that's kind of where we find ourselves today.
Brian, you did a great job of, I think, covering every sector, just like definitely the major ones. So that was a great overview of where we've been in the last 6 months and where we are right now. I do have a question for you about the corporate bond market.
Yeah.
Do you think that it has been stretched too far? And I have different questions from clients coming from different avenues. Do you feel like the corporate bond market has been stretched too far with everyone turning to get additional money based on lack of revenue so far this year?
So that's a great question. So, and I think I would say the way I would measure that, if it's been stretched too far, would be to look at what companies need right now. If you are an investor in a company and you asked, how should this company arrange its balance sheet in order to be well prepared for anything that happens? Change in legislation, uptick in COVID cases, vaccine, no vaccine, whatever the case may be. I think you would want that company to have a war chest, right? To have some additional finances arranged so that they could be flexible and weather things better than being, financed to the very edge where, they're running really lean and they don't necessarily have their, balance sheet set up in a way that would allow them to be flexible. So for that standpoint, I think, as an investor, you would encourage companies to put themselves in a better financial position to go to the corporate, bond markets and there's a lot less people issuing bonds or companies issuing bonds and then, paying a dividend, which is, one of the things that maybe many investors were questioning in terms of were they stretched too thin. It's a lot of more practical things that they're doing in terms of, whether it's paying down lines of credit that they had to use earlier in, or taking out some of the issues that, they had issued earlier this year that weren't as favorable. So improving their financial situation, taking advantage of the fact that interest rates are lower. All of those things, I think, are things that you'd want to see. And then the other thing would be, what's the appetite? What's the demand? And what's been remarkable this year is you've seen record issuance as companies adjust their balance sheets in the wake of everything going on. but that has been met with demand. So all along the way, you have investors, here in the US, but I'd say it's a much more global picture of investors that have an appetite to buy US corporate bonds. So, you have a lot of people that need that as part of what they're doing from their investment standpoint. You have, I think, good rationale for companies to utilize, the financial markets to improve their situation, to improve the odds that they continue to operate and can do that smoothly. So I wouldn't call that stretched. And I'd say the one indicator I would quote, at the risk of using something a little bit more technical, would be the spreads, the level where spreads have been. Okay. So, looking at, ICE, Bank of America, they have corporate spreads, and for investment grade issues. And when I say spreads, all I mean is when you buy a corporate bond, a certain amount of the interest you're getting is going to be the treasury, the risk-free yield. You could just go to the government and get it, right? And you don't have to take any risk that company ever pays you back, right? So that's what you call the risk-free yield. And the spread is all of the yield on top of that you currently get for the risk that the company might not pay you back, right? That's the risk of default. So you get compensated for that with additional interest versus just owning a government bond. So right now, spreads are at about 137. And before the crisis hit, they hit a low point of 99. So, and we're in basis points here. So, the spread was 1.37% above treasuries, or it is now, and it was 0.99% above treasuries. So the spreads haven't come down to where they were before. And spreads going down shows improvement because as a bond yield decreases, its value increases. Remember that teeter-totter relationship between bond values and interest rates. So we would expect as the bond yield goes down on that corporate bond, that its price is going up. So in other words, prices haven't appreciated to where they were earlier this year. And I think that's a big difference from fixed income, corporate markets to equity markets where you've hit all-time highs again. So if you use that as a barometer, I wouldn't say we're stretched thin. I still think that there's room for corporate credit to grind tighter. And I think one of the main catalysts for that is the fact that the Fed has a backstop with those two corporate credit facilities, where if there's an issue with how that market is functioning, the Federal Reserve will automatically begin increasing their purchases of corporate bonds, adding liquidity, adding cash to that market so that market participants can continue to operate normally.
Thank you.
Yeah.
That is a great answer.
Detailed answer.
A little, yeah. You left me speechless, Ryan, which is hard to do. All right, so one other question for you. From a Pacific Life, Pacific Funds standpoint, what are you, if you could share with us today, what are you looking at as far as fourth quarter and growth areas? I think the question, and I get it, I've gotten it a lot frequently, is has the tech bubble burst? So if there's any light that you can shed on what you guys are maybe putting more into focus in the next couple of months.
Yeah, so I would say, focus areas, we continue to like corporate credit. I think, equities, we anticipate more volatility leading up to the election. And then, it's going to be harder to predict how they react. And you're going to have, there's a lot of arguments that could be made on potential regulation that would get changed, and how markets would try to get ahead of that. But as we've seen from prior example, I think that's fraught. So I think it's really hard to say, harder to say now what a fourth quarter might bring, given that it's an election year, given that we're in a pandemic and awaiting the potential for a vaccine by the end of the year, which up until the last month or so, I think many more, we had run a poll in a call that we ran, 2/3 of people did not expect a vaccine by the end of the year. And I think, you've definitely seen a shift in that sentiment toward, a push to have things moved more quickly. So, there's so many things that can go either way. So I think, it would be probably a wise thing not to take any really strong bets into the fourth quarter, is what I'm getting around to saying.
Yep, I hear you. Is there any final words of wisdom or anything that you'd like to share with us?
No,
Okay.
other than, everybody stay safe in every way that you can, and, try to also take some time for yourself. I know this has been a challenging time in terms of what we've had to all deal with, and, many of us have been stretched in ways that never expected to be. And so, if you can find the time, which now that school has begun in different parts of the country, can be even harder to come by. I think it's even more important to take time, set time aside, do something for yourself, do something that's fun, and unwind a little bit.
Well, thank you. Thank you for all of your sharing your information today with us. I appreciate you taking the time. Kim, thank you for helping arrange this presentation. I greatly appreciate our partnership. And if there's nothing else, we'll sign off and wish everyone a happy rest of their Wednesday and rest of the week.
Thank you so much.
Thank you.